Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Phil. It's always great to have you on the podcast show.
Lovely. Great to see you, Bilal.
Great. Now, I guess it's as good a time as any to just get a check on your view on the US economy. There's lots of different things obviously have happened over the last 6 months, tariffs and so on. You know, the Fed hasn't cut rates, so the central banks have. So how would you characterize the US economy right now? And what is your view for the rest of this year?
Okay, I suppose simply put, we seem to be in a sort of stuck in a bit of a phase of below trend growth. Although, actually, maybe what I should emphasize is below growth that would have been below trend with the uncertain old trend. Maybe what we've got is slow growth with a new trend that's just a bit slower.
And on that trend growth that's a bit slower, is that how much of that is to do with Trump, and how much is that just to do with the U.S. economy in general? That that trend could actually just be lower anyway.
No, I think it's dominated by Trump effects, but probably not the sort of Trump effects we love to talk about, including on days like this when we had more wonderful trade agreements and all that. Yeah, I'm sure we'll talk about trade in a moment, but I think probably the dominant theme is the slowing in labor supply, which of course is really a Trump-driven phenomenon, although actually began through last year. So the peak in growth in effective labor supply for the North American economy, not just the US, came in 2023, and then we slowed pretty rapidly through 24, and I suspect we're contracting in 25. So it doesn't. Taking a very sort of almost like very elemental production function approach to projecting growth or growth capacity, essentially what's happened is we've probably lost a point or so off potential growth because of this labor force effect. And of course, Friday we'll get more insight on that. But, that's the reason why I think I think we'll learn more from data this week, at least the data they published this week. Whether it'll be the actual true data in 3 or 5 years' time, we'll see. But it looks like growth has slowed to 1% in the first half of the year, but unemployment hasn't risen. So, that's my premise to say, well, growth is slower. We used to think trend was 2, and it looks like it could be closer to 1 at the moment.
And on the labor supply side, so presumably a lot of that is to do with less immigration and the expulsion of lots of workers, documented, undocumented, and otherwise. So in that context, just in terms of how we should interpret payroll data in general, what is the steady state of payrolls? Which you as an economist would think is not going to increase unemployment, but could look bad when you look at the headline.
Yeah, I mean, I suppose given the current data set, big proviso, I would say it's probably even now under 100 or close to 100. Now that's going to be weaker when we get revisions to the data, which we're going to see, I guess, in early September this year, when they re-benchmark or give us a first guess at the re-benchmarking for payroll growth. And I think, frankly, the bottom line will be that we've been assuming more jobs being created than probably have been created over the past year. So when you factor that effect in, it's looking pretty sluggish here. But it's not it is a demand side story, because obviously demand and supply in some sense always add up. But the driver is not some exogenous shock from policy, let's say. Although, I would actually argue monetary policy is a bit too tight at the moment. But it's really a supply side story, one of the many supply side stories we've had over the last few years.
And you mentioned Fed policy, and how would the Fed view the labor market data? I mean, are they focused on payrolls, or would they just look at the unemployment rate? So if payrolls was to fall to say 100, it wouldn't necessarily scare them. Instead, they'll just look at the unemployment rate, which could in that context stay steady?
Yeah, I think they're looking, yes, 100% unemployment rate is the dominant variable on their mind, or put it another way around, and probably a necessary condition for them to ease would be something of a rise in the unemployment rate. I think the secondary indicator, which is important to watch, is very helpful. As I've probably said this a billion times, including on your podcasts. It's all about jobless claims. And, I think you really know an economy is beginning to deteriorate in a sort of fundamental sense when people start getting fired. And, that's not happening. Could be more that there's actually a bit of labor hoarding going on there.
And when I hear you talk, it sounds like we're having this negative labor supply shock. Then we've had tariffs as well.
Right.
And so if someone had told me this at the start of the year, and many people were talking about this, you would have thought inflation would pick up. Yet inflation's been remarkably benign over the last few prints. How do you interpret that? And what is the story about tariffs and inflation then?
Yep. No, I think obviously there's a number of ways of cutting this or looking at it, and in a way the Fed is, I think, a little bit probably not too smartly kind of emphasizing, well, you win some, you lose some, or we had a bad run, or we've had a good run, and we should average it all. And I think there's always some truth to that point, so seasonality issues become a problem. But I think what's really gone on here is that the economy has been weaker than we thought it was going to be. I mean, now you could say I argued earlier that was a supply side story, but I think also the demand side of the economy, especially consumer spending, has been weaker. And I think it's particularly shown in the service sector. So when I look at I kind of cut all the data up and sort of try and decompose it, to me, the surprise, there's been sort of, in a sense, two surprises. One is the extent to which profits have so far absorbed some of the tariff hikes. But the other real surprise, probably a bigger surprise to be honest, is the weakness of service sector pricing. So it's offset. So we have seen an acceleration in goods pricing, and it's been sort of clearer at the PPI end than it has been at the CPI end. So in that sense, I come back to my profits point. But in addition to that, we've seen a lot of weakness, surprising weakness for me at least, in the service numbers. And I think there's a bit of a problem here in some of these service sectors. Just before coming on, I was looking at a little story on Bloomberg saying that Las Vegas workers are suffering a tremendous diminution in their tip income because there just aren't as many gamblers and tourists in Las Vegas. So, they might be enjoying a tax break on their tips, but when the tips themselves are 50% of what they were a year earlier, that's not so good. But yeah, that's an anecdote, but I think it is reflective, and you see it in the macro data, that service sectors are softer so far this year.
And what's causing that softness in services?
Well, I think when we step back, and I think the problem with sort of analyzing economics under Trump is it's hard to step back because everything is so bewildering. You get sort of battered around day to day. But I think when we step back, what we're seeing put in place, and it's still really yet to be fully put in place, but it's coming, is a very regressive shift in economic policy. And I don't mean that, I mean that using the economics, the public finance concept of regressiveness, meaning, essentially the burden of taxation and to an extent spending is being placed on the poorer, spending going down, taxation going up, and the benefits are going to richer people. Now, I'm not trying to preach or anything. I'm just saying that more as a fact, let's say. And I think in that context, you're seeing a squeeze on people with, very high propensities to consume, including immigrants. And so a cutback quite quickly, and the cutback tends to be in discretionary items. And I think that tends to be rather more dominated by some of these service sectors that have been quite weak. So that's my best explanation so far. It's hard to see it in the income data, in the aggregate income data, because they don't look so weak as the spending data. And in fact, the saving rate's gone back up. So the way I think about it, and I'm always, I like to give explanations that fit with my a priori views. So I came into the year saying, yes, we're going to get a very regressive set of economic policies. And I didn't expect the demand side effect to come through quite as quickly as it has done. So there may just be some quirks here, but I think it is this phenomenon of the poorer getting squeezed a bit. And that's, for the US economy, that's a problem because, these are high spending, high propensity to spend individuals.
I mean, you've touched now on the fiscal side. So on the latest big beautiful bill that we've had passed, one is, what parts of that policy make it regressive as you've just described, and then a broader point is how you as an economist would interpret this type of fiscal policy package.
Right. So I mean, I suppose as an economist, particularly a Keynesian economist, I come at this saying, okay, what's the fiscal thrust components of these different pieces of legislation? And the way I look at it is the timing of this is such that we're going to get a tightening this year and an easing the year after of 20. So I'm really talking fiscal years. So a tightening in the current fiscal year 25, and then an easing in fiscal year 26 and 27. Now that's not relative to some CBO benchmark, because the easing in 26, 27 relative to that is huge because we were supposed to be raising taxes and we're no longer doing that. I'm talking about at the margin, which is sort of what counts for the real economy. And the reason we've got this tightening this year and easing 26 and 27 is, the tax policy of the Trump administration has been to raise indirect taxes this year, i.e. tariffs. Now we can talk in a moment about the incidence of who it's falling on, but they've raised tariff revenue this year and then are cutting direct taxes more next year and the year after. And the tariff, I'm assuming the tariff sort of revenue stays kind of steady state. It begins to fade away a bit once people adjust. And on the spending side, the regressive spending picture doesn't really kick in earnest until 27. It begins a bit in 26, but it kicks in earnest in 27 and 28. These are the famous Medicaid and other welfare cuts. And of course, that timing is partly driven by the election cycle. So they wait till they get beyond the midterms to sort of, enforce some of the pain. Let's put it that way. But the amounts aren't huge, relative to the stimulus that got added various points in the past. This is not a massive net tightening, but it is enough, I think, to this year to feed into that perception of economic weakness, slower economic growth.
And in terms of, when people talk about the fiscal side, it does generate, some of the more, apocalyptic type views about the level of US debt, US debts, that we're going to have a fiscal crisis and so on.
Right.
When I look at interest rates, 10-year interest rates seem to be fairly well behaved. Obviously, the longer end, 30-year, is at the high end of its range. So it seems like there's something the markets are worried about there. Do you have concerns about US fiscal sustainability in kind of, to the extent we can talk about that in a developed world context?
Yes. Do I have I spent a lot of my career in the emerging world, looking at emerging economies, and do I have the same considerations or concerns I used to have about imminent problems in especially Latin America? No, not yet. And a lot of that has to do with the structure of the debt as well as the level of the debt. But I think it's a general point, obviously, that as we look across the DM world, especially, but also many EM economies, you've got very healthy private sector financial positions, but increasingly worrisome public sector positions. So to me, it's more of a relative asset price trade, meaning, we used to have a sort of sense that governments always set the benchmark or the low levels for rates, especially, and the private sector sort of stacked on top according to risk. We're probably in a world a little bit here where certainly those spreads are narrowing, the credit spreads, as well as term premium spreads are narrowing, and term premium are widening when the credit spreads are narrowing. And there's a bit of a sort of repricing of government debt everywhere relative to private debt. And that's true in the US as well. I mean, I've noticed this year that, as you mentioned, the 30-year government rate has gone up, but the 30-year mortgage rate hasn't moved very much. It wobbles about, but it's actually compressed. The rate at which an average borrower can borrow to buy a house has gone down relative to the government yield by about 50 basis points so far this year.
Actually, now that you mentioned mortgages, what's the state of US housing? And is that relevant in terms of how you look at growth? Because
I
in terms
earlier,
of the margin or not?
I have a lot of arguments with my colleagues who are sort of working for real financial firms on Wall Street, who have to sort of, look respectable. And I've been saying for the last few weeks now, I can see the case for the Fed to ease this Wednesday. They're not going to. And, if they did, people would say, the independence gone, they've yielded to Trump, blah, blah, blah. But I actually think Chris Waller's arguments are really quite reasonable, what he's saying. And one of them, is that interest rate sensitive bits of the economy are not doing well. And housing specifically is actually weakened quite appreciably through this year. Now, maybe some of that goes back to the message about squeeze on people who are trying to get into the housing market. They've become even more miserable and are not doing that. But I think a lot of it is just that the conditions facing housing reflect a tight monetary policy. And there's an argument, I think a very compelling argument, to say, let's just recalibrate a bit lower and see what happens. Not 300%, 300 basis points, according to Trump, etc. But just, give a quarter point and let's see if that provides a little support to the housing market.
And just for the listeners' reference, we're recording this on Monday, the 28th of July. So this is before the Fed meeting and before payrolls as well. On the Fed, more generally then, you seem to imply that the Fed could or should be easing, but at the same time, there's this Trump pressure as well. So how would you score the Fed then so far this year? Just purely from a economic perspective to start with, and then we can talk about the Fed independent side.
Yeah, I think they have been a little bit behind the curve in so many ways in recent years. And I think they've got a little too evangelical on inflation this year, when in fact, it's less of a problem than it was, let's say, last year. They're probably not as focused on growth, the growth slowdown as they could be. Obviously, it's a difficult political environment, to say the least, and it's an unusual economic environment. But if I were them, I think I'd be a little more, less tone deaf to the broader environment that's out there. Especially when you've got the ECB, 7 cuts in a row. And that sort of stands out and the BOJ should have been hiking, 7 times in a row, and it hasn't. I'm exaggerating, but the BOJ has been very dovish. The ECB has been very dovish. Most other smaller central banks have cut where they can, and the Fed's been I think a little bit sort of too resistant. And you could argue one of the arguments, forget the tariff story and the Trump story, is they've come to realize that equilibrium real rates are higher than they've been saying for the last decade. And that's another example of them being behind the curve. I think everywhere you look, you get this sense that they've just been a bit sloppy and slow. And of course, I'm not trying to pretend I'm echoing the Trump line, but he kind of does have a point, if you don't mind me saying it.
And on the Trump influence or his comments and trolling of the Fed, how unprecedented is that? I mean, how should the Fed respond? I mean, do we need to worry that, the US will become like a sort of country like a Turkey or, some Latin American countries historically?
Well, my point with any economics analysis is never say never. But as I mentioned earlier, I don't think this is quite yet an EM situation. And you ask historically, what the precedents, and there are many of them, And in fact, you and I both grew up in the sort of, let's call it the post, the Greenspan era onwards. And I think we got used to this idea that was really a 1991, 92, 93 thing, that central banks need to be independent. And we've carried that banner, and I carry that banner still. I'm a big believer in central bank independence. But I mean, 10 years before, in 1983, I joined the Bank of England, and we basically were told what to do by the Treasury. And by the way, for the first few years I worked there, policy was very tight because that's what Margaret Thatcher and Nigel Lawson wanted. So you don't necessarily get too easy a monetary policy with political control. It just depends on the preferences of the politicians. Obviously, at the moment, we've got a very easy money guy who would be a disaster if he set policy. So it's not the loss of independence per se that's the problem. It's who you hand the keys over to. Is it your responsible sort of 60-year-old uncle, or is it your reckless teenage driver? And Trump would be a reckless teenage driver as a monetary policy maker.
Okay, great. Now, let's move on to the rest of the world.
Yeah.
The euro area, lots of interesting dynamics going on there. We've had the German fiscal story earlier on in the year. Now Europe's having to contend with this sort of trade dynamics. There's been an ongoing issue around the growth of Chinese exports that are kind of affecting sort of German dominance in general. How do you put it all together for Europe?
Well, I think the interesting thing to me about Europe is, I think with the Ukraine war and the gas price surge in 22, 23, we just sort of got into almost structural pessimism. And then on top of that, here comes Trump, and it's, oh my God, this is the last nail in the coffin, especially for Germany. And I certainly had some fears about that, but then we sort of saw, two things have happened. One is the worst case, as reflected by the so-called deal over the weekend. The worst case trade picture hasn't played out for Europe yet, at least. But more importantly, we've seen a big rotation in German thinking. And then on top of that, and I think this is a really important point that we shouldn't lose sight of, is we've had these sort of distortions in demand for European product, especially for Ireland and a few other countries, but Germany as well, caused by tariff threats in the United States. And I think that gave us a sense of economic strength in the first 4 or 5 months of the year, especially from sort of March through April, let's say. I guess it was February, March, and then a bit of a drop in April, rebound in May. So I think what comes next is a bit less obvious, some risk of disappointment. In fact, the ECB has in its forecast a Q3 contraction. So in that sense, it shouldn't be too much of a surprise. But I think on balance, Europe is doing better. But, we're not talking, 0 to 3% growth. We're talking more about 0 to 1% perhaps. But it's not 0 to -1 or -2, which was a worry end of last year, start of this year.
I mean, there is this narrative that, Germany, even though they do have this sort of fiscal story that's a bit more relaxed now, in the end, they can't compete with the Chinese. The Chinese export engine is so large now. The earlier historic support Germany would get from exporting to China is gone. So China's a negative for Germany. And then at the same time, you still do have this energy issue, even though it's been managed much better. So from a structural perspective, I mean, like, should one just be structurally pessimistic, or can there, is there a different view?
Well, I think yes, there are many. The list of constraints on German, but also broader EU growth are pretty significant, and the demographics are a big part of that. But I do think one of the things that's changing is, and this is possibly me being too optimistic, but I think it is happening, is a sort of greater optimism about investment in Europe and the prospects for increased investment in defense, increased investment in technology, increased investment in infrastructure. Now, it's easy to say these things, harder to do them, and the UK is a very graphic example of that, sort of as we speak. But I do think the Germans have a little bit of a track record, with reunification, some of these other programs, to actually execute on things like infrastructure projects. You could actually say, I wasn't one of them, but many economists were very critical of Germany's fiscal programs over the last decade, way too austere and all that. But actually, they kept their powder dry for when they really needed it. And you're going to see some of the benefits of being able to use your fiscal space, as people like to use the phrase, and be able to, increase investment that way. That's obviously something the UK government is very much ruining at the moment.
Speaking of the UK, I mean, you're visiting. I mean, you're based in the US, but right now you're actually in the UK. It's hard to find many people too optimistic on the UK, especially people in the financial sector, and much of our audience are very gloomy about the UK. Is that fair to have this negative view?
Yeah, I think so. I mean, to me, two things have. I mean, I really am try to be a UK optimist wherever I can, especially when I'm abroad, as a sort of ambassador for the UK, informal. But I think two things to me have been a problem, more of a problem than I expected. One has been this, I mean, just the incredible inertia from the UK government. In its first year in office, it came in with a grand vision, and just has been terrible at executing its vision. Or let me, my favorite example is, here's a government that came in and realized straight away it had a fiscal challenge. So they think about it and announce 4 months after they come in that they're going to tighten policy. But most of that tightening won't take place until 9 months or something like that after they come in. So you've got this horrendous period of doing nothing and waiting and like telling everyone it's going to get worse, and it does get worse. And why didn't they immediately say, "Oh, we've got a big problem here. We need to tighten straight away"? Blame it all on the other guys and sort of get the bad stuff. It's very much what Margaret Thatcher did in '79. She got all the bad stuff out of the way. Actually put the economy into recession, but was able to sort of rebound from it. And I worry that what the Labour government has done is the opposite. It's sort of kind of sat there and just rubbed its hand and said, "Oh, we're not sure what to do. We've got all these plans, but we just can't do anything because we're hamstrung." So that's one problem. And I think the other problem is I didn't think the growth inflation trade-off would be quite as difficult as it's proven to be. In other words, I did expect inflation to be lower, and I expected especially wage inflation to be lower. And every time I look at the UK wage data, I scratch my head a bit and try and understand what the hell's going on. I wish.
And what is going on?
Well, it's the lack of. I think the labour market is weakening, and I think the national insurance hikes fed into that very significantly. But what we're seeing everywhere else, when I look at various labour data sets, all of them, they often give off slightly different pictures according to which numbers you're looking at, official versus private and surveys and stuff like that. But the consistent message in most of these, especially these wage surveys, is that wage growth is decelerating significantly everywhere, apart from the UK. Now, it's going to happen in the UK, according to various Bank of England surveys. But so far, we're seeing sort of wage growth increasingly in a number of countries with a two handle on it. And the UK wage growth numbers have a sort of five handle on them still. And that, they're going to get to 3.5, I think, next year. But, I'm less confident of that than I was 3 months ago.
But what is it about the UK that's
Sorry?
what is it about the UK that's keeping wage growth so high?
Well, in a way, I mean, not that I'm trying to end our discussion or anything, but it's closing the circle and coming back to the discussion about the US, where, in a way, the UK could be a role model in the worst possible way for the US economy. We had our supply shock, instead of our Trump shock, we had our Brexit shock starting in 2016, but really in 2019, 20. And of course, it came on top of COVID, etc. And I think what that did is it fundamentally made the UK economy a less elastic economy, both in goods supply terms and labor supply terms. And it therefore, frankly, worsened the sort of growth inflation trade-off, where shifted the Phillips curve, put it as you wish. And I think, that's where the US is heading. Coming back, not trying to get back to the US, but that's where the US is heading, not this year, not straight away, but over time. So I think one of the sort of important aspects of what's gone on with economics over the last few years is we've had things happen and people look for instant effects. And it doesn't think, it's not like we've had major changes. The changes are very significant, but they take a while to have their impact. And I mean, one of my favorite examples is the regulatory tightening that we had in the banking system immediately after the financial crisis, which was good in theory, but terrible in practice. And it ended up creating a much weaker, extended phase of disappointing recovery. And the same thing's been true of Brexit, where, you had an event that, people said, well, it's going to be bad. And when it wasn't instantly bad, all the pro-Brexit people said, this was all Project Fear and all that. Now we're getting, Trump tariffs and everyone's saying, oh, look, he's done all this and nothing's happened. Well, first of all, growth has slowed very dramatically and second, inflation's gone up. But the real negative of this strategy will show over time. And as I said, I think that's where we are in Britain. We're seeing in 25, 26, the legacy of a sort of supply shock over a decade. And if you make your economy less open and less elastic, it's going to happen to you.
And then on China, which is, kind of captures many of these themes, we still seem to be in a world where China's not like a net contributor to net demand of the world. It's like a supplier to the world and a disinflationary force.
Right.
And we've had, over the weekend, this recent announcement that looks like, a fairly positive outcome for, tariffs, which should help China, I guess.
Yeah.
So what's your view on the China part of this global story?
Well, I think, first of all, China is a big closed economy. It's open in the sense that it dominates world trade, but it's a very big closed economy. And in that sense, what really drives China is China. And, their biggest development continues to be their demographic crunch. And so we are seeing an unambiguous trend slowdown in China. So I think we've got to get used to sort of seeing 3 to 4% growth in China rather than 5, 6, 7. And so, I'm not optimistic on, a Chinese boom. Related to that, I think we've got a problem still with, as you mentioned, the Chinese consumer. That they ramped their saving rate up through the last few years, especially through COVID, and are yet to really sort of push it down. Now, I think some of that has to do with, I wouldn't call it Ricardian equivalence, but it has to do with the sort of recognition that the government is now playing a much bigger role in the economy, and the budget deficit, however you measure it, has gone up very sharply. And so, this is not a sort of healthy mix as far as I'm concerned. Now, and then you mentioned earlier, and I think this is a really important point from a global perspective, is China also now seems to be beginning to dominate world trade well beyond Europe and the United States. And I think of that as the payoff to their Belt and Road initiative. I remember, a decade ago, many of my colleagues sort of laughing at this Chinese idea, why would they do all this investment in these terrible places? Well, I think now we're seeing why they would do all that investment, which takes me to my final point on China, which is this is the country in the world that can still invest, and it's, I think what we're discovering in many parts of the DM world is it's hard now to get that propensity to invest up. We're seeing it a little bit in the AI boom and, everything associated with that, which is very concentrated in the US. But in Europe, it's just hard to get that investment up. In China, they keep investing. And it's, I was struck last week by this new project that got announced in Tibet, or got put really emphasized in Tibet, where they're going to build a dam structure that is multiple times the size of the Three Gorges project, which was a massive boost to the Chinese economy in the 1990s. So I think what you've got going on here is a state-led Chinese economy that is still able to invest, nowhere near as productively as it used to be able to do. So growth in aggregate will be slower, but they will be continuing to flood world markets with product. So whether that's deflationary, I guess it is, but you've got a lot of consumers out there who are buying the stuff. So what it really is you've got a global economy that continues to grow okay, even though the DM segment keeps shrinking in relative terms. So this sort of Trumpian US perception of relative decline will actually accelerate rather than decelerate.
And then, let's round off our conversation with the sort of remaining larger Asian economies, Japan and Korea. Mm-hmm. How do you think they're faring in this kind of Trumpian world and its sort of very dominant China sort of manufacturing world?
Well, I mean, I think not very well, but a lot of that has to do with their own woes. I mean, clearly the star performer here is Taiwan, which, is sort of weirdly caught between, support from China as China ramps up its tech expansion, and most importantly from NVIDIA and the AI boom in the United States. And Singapore seems to be kind of doing okay, but not spectacularly. But I think both Korea and Japan suffer from a mix of domestic woes. I mean, the Korean political situation past 18 months has obviously been a bit of a disaster, maybe settling down now, but I wouldn't count on permanence there. And this does seem to be an economy that has somewhat slipped behind its peers, let's say, its competitors, especially Taiwan. And, it's Korea is almost like the national equivalent of Intel. You go back.
Oh no!
Go back 10 years, you'd have said, think of a semiconductor company. We'd all said Intel. Think of a country that produces semiconductors, Korea. But they both managed this sort of relative decline, or experienced this relative decline. Japan, of course, predates all that with its own relative decline. But I think that the fascinating aspect to me about Japan has been this. I don't think I've ever seen an economy where we've seen such a rapid and sustained rotation to profits from wage income. If you look at the start of Abenomics, the profit share in Japan was, a bit below that in the United States, at least on the national accounts level. Now it's, I want to say almost double the US rate. And so there's been this incredible shift that's helped the corporate sector, but squeezed the personal sector, squeezed the household sector. And of course, the inflation success that the BOJ has engineered has just compounded that. So pricing power has returned for Japanese corporates, but households feel screwed. And they feel screwed in two ways. One, every time they get a wage rise, it gets offset by inflation. And two, many of them, especially the older community, hold fixed income assets. And this is, it's in a pretty significant use of the inflation tax to erode the real value of those assets. So, Japan is more of a story almost of relative fortunes. If you look over here, it looks pretty good. If you look at the businesses, look at the Tankan or whatever, you look at, the consumer confidence, it's terrible.
Okay. And so what would you, just to finalize the sort of wrap up the sort of macro part of the conversation, what would you say is the strongest view you have that's different from other economists at the moment, whether it's a particular central bank view or a thematic view?
Yeah, I suppose at the moment it's hard to drive much of a wedge between what I'm saying and what others are saying. I have these sort of fits where I say something week by week and it's either horribly wrong or horribly right, if you see what I mean. So I'm not sure I could, when I look for, a lot of what I do is the bread and butter stuff of looking at monetary policy calls and looking at market pricing versus what I'm saying. And to be honest, it's not that different. I think probably the biggest difference in that context is I still think Japanese rates head towards 1.5 next year, so just because they've done nothing this year doesn't mean to say they don't ultimately get to 1.5, and that obviously has yen implications and all that. But I think my biggest sort of table thumper here is to say, stick with the program. What I mean by that is, as I was alluding to earlier, we've had this situation where, we have this set of Trump policy changes and everyone said, it's going to do nothing. And then it was, oh my God, it's going to do a lot. And actually the reality is that it's going to have its corrosive effect, but, partly because he backed away in April, it's not going to be a sudden dramatic change. It's going to be a corrosive drag on the US economy. And I think that has three implications. One is it's weaker for the dollar. Two, and this is where I've been, probably my worst call has consistently been in this area. I think it's bad for equities. I've been wrong on that a lot, but I still think the US equity market is looking vulnerable as we head into next year. And three, I think this is all curve steepening. So, let's say he gets his low interest man or woman, almost 99% certain to be a man in May of 26. I think that just continues and accelerates Fed easing into 26. So actually one point I should have made is that actually my Fed call now for 26 is much more benign than the markets. So I've got a hawkish Japanese view relative to the market and a benign Fed view, but that's for 26, not for 25. If you see what I mean? And 26 views are probably not worth the paper they're written on, to be honest. But anyway, but I am fairly confident that the curve will continue to remain quite steep and probably steepen further as short rates come down and the long end remains nervous and possibly increasingly nervous as the budget progress. By the way, US budget progress will look quite good this year because we've got tightening and we've also got looming some accounting effects. They undermined, they basically reneged on a lot of debt relief offers that Biden had made. I know a guy who, is a doctor who's suddenly facing a much bigger student loan bill because, he was expecting to get it forgiven because he'd worked in hospitals for a certain period of time. And the agreement was, if you did that, you got your loans forgiven. They've ended that. So his loans kick back in. These were pretty well paid, so he'll have to pay them. But, that's another effect that will cause deficit this year, because they're going to accrue it all in this year. That's the story. Even though the cash flows come over time, they're going to accrue it straight away. So that will help lower the deficit this year. Anyway,
that's fantastic. And you write perhaps one of the best global economic dailies in the market, I would say. So what's the best way for people to reach out to you, connect with your service?
Right. Well, I mean, we're very visible, and the best way is Phil at suttleeconomics.com. Just email me, phil@suttleeconomics.com. You can go on our website, which is not surprisingly called suttleeconomics.com, SUTTLE economics.com, and see some of what I do. But my best advert is people like you, Bilal. And thank you for your support, because everything is great thanks to people like you.
No, fantastic. Well, with that, thanks a lot, Phil, and hopefully you have a great time in the UK here during the summer.
Well, I should say one more thing, which is I'm eternally optimistic about my hometown soccer team, Luton Town, and I can feel a promotion coming on this year. Of course,
Luton Town.
That comes after 2 relegations, so it would be 2 steps back, 1 step forward. But I am optimistic about the town.
We'll hold you to that as the Premier as the football season starts soon.
Terrific. Thanks, Bilal.
Great. Thanks a lot.
Say bye.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.